for everybody. Is it coming through clearly? Too loud? Too soft? Down just a touch. Okay, let's try that. How's that? All right, so yeah, I've got it kind of centered, so it's too low. Probably be good to turn it up on your end. That way it doesn't come through pixelated. All right. All right, well, Morgan, thanks for having me. It's always a pleasure to be here with the Trading Pub, and I know you guys could be anywhere here on a Saturday summer afternoon, and you're here with us, so I really appreciate that. And you know, what we're going to be covering today is the three keys for finding confidence in your trading strategy, and I think this is going to be a great caveat to Jeff's presentation. You know, talking about strategy development, and you know, ever since 2008, I've become kind of a strategy development geek, and so I'm going to show you some of the lessons that that I've learned over the past few years, and you know, hopefully give you some insight, no matter what market or time frame that you're trading. So before we jump in, I'm sure you guys have seen this 101 times. You know, futures trading is risky. A lot of traders lose money. I'm not a trading advisor, and so this is for, you know, education purposes only. And what I'm going to cover today is basically how to leverage your time by trading E-mini futures with a rules-based strategy. But more importantly, really the three keys to gain confidence in your trading strategy, no matter what market or time frame you're trading, and really how to develop consistency in your execution, because I think that's the most important thing. If you don't make consistent trading decisions, you're not going to see consistent trading results. And I think it all starts with strategy development and just really having a clear-cut method for how you approach the markets. And I also think that old school discretionary trading is broken, and I'm going to talk about a little bit about why I think that's true, and also how to combine the benefits of automation with the skill set of analyzing real-time market conditions. Yeah, Rick, so that's actually a great question, and I'll get to that here in a second. You know, why should you listen to me? Again, my name's Chris Dunn, and I started trading around 2001. I was actually trading stock breakouts at the time, and it was kind of when, you know, high-speed internet connections were becoming reasonable for, you know, individual traders. And so I quickly moved into the E-mini markets, and I'll talk about why I did that here in a second. But over the years, I noticed around 2008, there was a big change in market conditions. You know, a lot of the things that were working in the early 2000s just weren't working anymore. And, you know, price action was becoming choppier, the market was becoming more erratic, and it was becoming harder to trade. And the reason for that, I think, is because of, you know, the algorithms and the high frequency bots that were coming into the market. And so that's around the time that I really moved into developing rules-based and semi-automated strategies. And so I'm going to talk about that today, basically the process that I go through whenever I'm looking to develop and test a strategy, and kind of the key components and just how to think about it in a methodical way. So even if you're not a day trader, or if you're, you know, trading equities or, you know, Forex or whatever, I think that this kind of methodical approach can really help you out. I'm also an adventure travel junkie, as Morgan said, which I think is kind of relevant for trading because, you know, doing things like scuba diving and skydiving and going mountaineering through the Himalayas takes a level of risk tolerance, as does trading. And so it's just really nice to be able to break away. And as you guys know, you can trade from anywhere in the world with a high-speed internet connection. So yeah, absolutely, Brian, avoiding the dark pools. The E-mini Academy, I started back around 2008, and fast forward to today, we now have student traders in over 30 countries. We do daily live trading education and just have an incredible support team. And again, I'm not here to sell you anything today, guys, or tell you that my way is the best way. Really, I just want to give you some insight into some of the lessons that I've learned and hopefully save you some time, money, and frustration. So why trade E-minis? You know, I actually trade E-minis and equities, and I think there's just some really big benefits to trading the E-mini markets. And I tend to focus on what I call the big three market segments, like stock indices like the S&P 500, the Dow, Russell, and NASDAQ. I also like commodities like oil and gold when they're in play. You know, when they're not in play, it can get really choppy. I also like to trade currencies like the euro, but I like to trade Forex through the futures exchange. And the reason why is you have price transparency. And I find the futures markets to be sometimes a little less choppy than just the standard Forex markets. You also have a healthy level of volatility and liquidity, which gives you a lot of intraday opportunity. If we look at the E-mini S&P daily chart, you can see, over the past 30 days or so, we've had an average of over 2 million contracts per day traded on the E-mini S&P, which compare that with, say, penny stocks or microcap stocks where they have very low to no liquidity for periods of time and then kind of big volume spikes. I just really like the E-mini markets because you have kind of constant liquidity, money flowing in and out of the market throughout the entire trading day. And so that just, in a lot of cases, can create more trading opportunities. One thing I will say about the E-mini markets is it's a professionals market, right? If you come in and you try to like randomly just throw in orders or go in with an undisciplined approach, you're going to get chopped out really quickly. And so I'm going to actually show you guys a couple of different strategies today. One, which is my kind of semi-automated rules-based approach for E-minis, and then also my equities trading strategy, just to kind of give you guys some perspective in a couple of different markets. So let me just ask, before we move on, how many of you guys are actively trading the E-minis right now? If you're actively trading the E-minis, just throw a Y in the chat room. Okay, great. So quite a few. And how many of you are day trading or swing trading equities or stocks? Just a quick Y in the chat room. Okay, great. So we have a really good mix here. So again, guys, I'm talking about E-minis for the example that we're going to use, but this process I think is going to be relevant no matter what you're trading. So I want to talk about what I call the hindsight paradox. And I always like to say, everything is perfect in hindsight. It's always 20/20 in hindsight, right? I can look at any chart, any market, any time frame with any indicator and justify reasons why you could have bought or sold at a particular area based on price action or, based on an indicator. And it's really easy to cherry pick in historical charts, right? I can look at this and go, well, at this point, you had divergence on this indicator, you had a crossover here, you had, support level. So if you bought, look at that big run. And, it's really easy, again, just to kind of look back in hindsight and cherry pick, right? And find lucky cherry pick trades. And I think a lot of the old school kind of technical analysis that used to work in the early 2000s is broken today. A lot of the standard kind of, MACD crossover or moving average crossover strategies, a lot of those really don't have an edge in today's market. And the goal of every trader really is to find a unique, long-lasting edge, right? Not just like lucky accidental winners. And I think that subjective traders or purely discretionary trading, trying to read the markets or just look at indicators and make in the heat of battle decisions, what that does is it opens you up to massive amounts of human error or emotions, right? Has anybody ever looked at the market and either been a discretionary trader or maybe you are a discretionary trader and say you're looking at some indicators and price action's moving live and you think you kind of have an idea for what your setup looks like, but maybe you're not completely confident on when to pull the trigger? Has anybody ever battled with that, hesitating on pulling the trigger to get into a trade? Okay, so quite a few of you, yeah. And one thing I'll tell you is we actually recently surveyed about 15,000 traders and we said, what are the biggest problems that you have as a trader? And the two things that really stuck out were hesitating on entries and then closing their trades too early, right? So think about that, hesitating on pulling the trigger and then closing the trade before it gets to your profit target. And what we found was that stemmed from, and yeah, HP said it, fear delayed entry, early exit. Yeah. What that stems from in a lot of cases is a lack in confidence in either your trading strategy or your ability to execute your strategy. Okay. And so I want to give you a process that I go through to try to minimize those issues, right? And to try to kind of get past that or give yourself confidence in your strategy and your ability to execute that strategy. And to do that, you need to quantitatively define, test, and analyze your idea to see if it really holds any merit, right? To make sure that you're not just, cherry picking or looking for lucky accidental scenarios. And if you guys haven't read that book, Fooled by Randomness, it's really good and it's relevant for traders because it talks about how humans are pattern-seeking species, and we'll find patterns in things where there really are no patterns, right? Like looking at the clouds and seeing an elephant when there really isn't an elephant there. It's just a random set of clouds, but we tend to see patterns there. And so I think it's just really, really important where we are in the later part of 2013 that if you're going to compete in any market, you really, really need to quantify your strategy. And I know Jeff touched on this quite a bit. And so I'm going to try to just show you my methodical process for doing this. And I'll tell you this too, I'm not a fan of black box automated systems. I don't believe that you should just create a black box or a completely automated system and then let it run on autopilot forever and expect it to make you rich. That's just not how it works. But I do think that there is merit to automation. Right now, and there's a bit of uncertainty here, but 50 to 70% of the market volume is traded by algorithms, and algos are actually designed to take advantage of the slower, more emotional trader, right? And so what using at least some form of automation can do is reduce or eliminate things like guessing or chasing or cherry picking. And again, the goal is to find a truly non-random, long-lasting strategy with a unique edge versus a system that just happens to get lucky from random inputs. And with the trading platforms that we have today, Metastock, TradeStation, NinjaTrader, there's really good back testing tools. But at the end of the day, the question is, are you finding just the luckiest accidental winners, or are you really discovering a unique, long-lasting edge, right? And that's kind of the goal in any market or any time frame. And so before I go through that process, I'm just going to tell you some of the drawbacks and the limitations to building a strategy. Most optimized strategies fail because they're over-optimized or they're curve fit based on luckiest accidental winners, right? So if you guys have ever seen those Forex robot advertisements that say, trading robot wins 90% of the time and earns 50,000% in 30 days, basically what that is they ran a back test and they said, okay, if we would have done X, Y, and Z perfectly, we would have made $1 million. And so we anticipate that if we do the same thing in the future, we're going to make the same amount of money. But as we all know today, that's not how the markets work, right? The markets are dynamic. They're always changing. And so what worked last week or last month may or may not work going forward, right? And so one thing I'll just say is if you ever run a back test, one thing that you really need to kind of keep in mind is that the max profit results can be deceiving. There's other things that you need to consider, like drawdowns, profit factors, outlier profits. Basically, did one trade make up 90% of your profit, and then the rest of the trade's lost? And so if you didn't get a fill in that trade, your results would have been dramatically different. Those are the kind of things that you need to consider when looking at strategy development. And yeah, Bill, I agree. The average true range is something that's really important to look at. And one thing that I do, okay, and so this is some of the meat and potatoes, is whenever we're developing a strategy or testing a strategy, we like to put it in the context of broad market conditions. And what I mean by that is different strategies will perform differently under different market conditions. And so over the past 6 years, we've actually seen this three-phase pattern play out at least once a year in the markets, the broad markets like the S&P 500 or the Dow or NASDAQ, what this three-phase pattern is it typically starts out with a slow bullish trend. And we saw this from the first trading day of the year. So here's the first trading day of 2013. And you'll notice all the way up until late May, we were basically in a slow kind of bullish trend. And what I mean by slow is the average volume. So if you look here in January and February, the average volume was lower. The ATR, or the average daily range, the trading range, was much lower. And every dip or every retracement that we saw in the market got bought up very quickly. Now, after you have kind of this over exuberant bullishness, phase two is typically a fast panic, right? And you can see here from kind of the beginning of the month, the market is sold off quite a bit. Now, I wouldn't say we're necessarily in a bear market, but you'll notice whenever the market goes into this kind of fast panic, volume increases, the ATR increases, and just the speed in which the market trades really goes up, right? And then what typically happens after this panic is wild volatility, right? And I'll show you another example of this. For those of you that were trading back in 2010 during the flash crash, here, this is just a really good example of the three-phase pattern too. You'll notice here for about 90 days, the market was in a slower bullish trend, followed by a really fast panic, right? This is the flash crash. And then phase three was, probably 4 or 5 months of just wild volatility. And so the idea is to realize that whatever strategy you're using, it will perform differently under different market conditions. The EMAs that I have on here are in 1855 and 89. And there's no magic to that. It's just kind of what we use. So again, the idea is just to really put whatever strategy you're using into the broad context of the market, and just know that whenever there are shifts in market conditions, the strategies that were working really well in a slow bullish trend may not work the same way when the market's crashing, right? And so if you start there, I think it's really just going to help you avoid, big unnecessary drawdowns. Okay, so my trading philosophy is twofold. Number one is I want to use a rules-based strategy, basically something that can be fully tested to make sure we're not cherry picking, hindsight trading, or chasing the market. But at the same time, I don't want to over-optimize or curve fit. And the goal is to stay flexible with changing market conditions, okay? So I have a 3-step process for how I do this. And let's go ahead and jump into that right now. So step number 1 is to start and define a rules-based testable strategy. And to do that, you need to have clear rules for finding, entering, and managing trade setups. That's it. Really, the only 2 things that you can do in the market are enter and manage trades, right? Everything else is outside of your control. And I think this should be more than, subjectively reading indicators or reading the market. You need to have a way to find, all your statistics, win ratios, profit factors, and other key statistics. And this is an example of my intraday futures trading strategy. Just with the trade signals, and this is just kind of a visual representation of my intraday strategy on the E-mini market. Okay, so that's step 1. You start with a clearly defined strategy. Number 2 is to understand what parameters are quote unquote working best in current market conditions. In other words, what profit targets, what stop sizes, and indicator settings are showing the best profit potential right now. It's helpful to back test and look at, 6 months ago, a year ago, even last month, but what is the market doing right now, and what parameters are working best right now? And so I think the best way to do that, and the process that we like to go through, is we combine back testing, walk forward testing, and live market testing. And if you've never done walk forward testing, it's a really great way to try to overcome over optimization or curve fitting. HP, what parameters do you use to see changes in market conditions? So Basically, we just look at the intraday kind of market environment as well as the broad market context, right? Like what's the market doing? Are we in a panicking market? Is it a slow trend? And then we basically test to say, okay, we know we have this set up and this management plan. Is the stop that we've been using over the past couple of weeks, is that still giving us the best profit potential, or has there been a shift and maybe we need to make adjustments to that? Okay, and again, the goal is to strive to always find an edge, not just lucky accidental winners. Okay, and then number 3, and I think this is most important, is to implement a dynamic and flexible live trading plan. So basically have a way to recognize when market conditions actually change. And so one thing that I've done for my intraday trading strategy is we've actually coded our software to let us know, okay, this market condition is choppy, or it's whipsawing, or there's no edge really to market direction. And so we want to stay away. And then we want to recognize when we break out of choppiness and say go into a strong trend or have a mid-morning reversal, things like that. And this is where I think being in the right trading room can actually help. I think a lot of trading rooms are a distraction. You have people just kind of throwing in random opinions about the market. But if you have a lot of people that are focused on kind of the same approach and looking for the same things, it can really help clarify that edge in the market and help you recognize when market conditions are actually changing. Does that make sense, guys? Let me just get a quick why if you're still with me and you understand those 3 steps. So again, step number 1, start with a rules-based strategy. Number 2, really be able to understand the parameters that are working in current market conditions. And then number 3, implement a dynamic live trading plan, basically a way to really recognize when intraday market conditions are shifting. Awesome, good stuff. So my first example, kind of a case study, is what I call my map trading strategy. And this is my intraday strategy for the E-mini markets. And just to give you kind of the 30,000 foot overview of how I approach the E-mini markets. Number 1, I'm looking to trade with market strength, with immediate momentum. In other words, I'm not looking to pick tops or bottoms or chase price, looking for wholesale opportunities, and really just looking for short-term calculated moves. On average, our average trade time, and this is actually yesterday, Friday morning, our average trade time is about 15 minutes. Sometimes it's shorter, obviously sometimes it's longer, but on average we're in about 15 minutes and just looking for these shorter term calculated moves. And one thing that I really like to use for day trading E-minis is tick charts. And the reason for that is I think you can get a really good read on intraday kind of the psychology behind price action. You can get a really good feel for momentum and market direction. And the other thing I'll say is my risk to reward plan is dynamic based on current market conditions. So if, say, we're in a period of wild volatility, my profit targets are going to be a lot bigger than, say, just a slow kind of grinding trend where there's not a lot of intraday range. Thanks, Jackie. Let's see here. Get to some questions. Thanks, Candace. Yeah, sorry, Doug. I know I'm going really fast through this, so I'm sure Morgan will send out the recording. And I'm going to tell you guys a little bit later about a live market class I'm going to be doing in a few days. And we'll have, probably 3 hours just to really dive into the live market and do unlimited Q&A and stuff like that. But I really just wanted to pack as much as I can into the time that we have today. Yeah, thanks, Morgan. Okay, so that's my E-mini strategy. Now, I also trade equities, and my wife is actually a full-time stock trader. And the reason why is she actually has time to do the scanning, and she spends a lot of time doing research. And so something I like about E-minis is there's little to no research. We're trading just a handful of markets. And so um, one thing with stock trading is, as a lot of you guys know, is you need to first identify potential stocks that could be in play for the next day. And I think it's really important, even if you're trading, lower liquidity stocks, is to really just define what a trade setup means for you. Again, and I think it's just important to really define the criteria for this is, what a trend trade looks like. This is what maybe a reversal trade looks like. Just to really help guard against manufacturing trades in your mind that really don't have an edge, right? So one thing that we like to do in the stock market, and I have a lot of videos on this, is to predefine reward to risk ratios by using kind of a confluence of multiple time frames. And so in the live market class next week, I'll actually go through that with you. But I think in the equities market, it's really important to be very precise with your entries and exits. And obviously the trading arena has gotten quicker and quicker over the years since 2008 because of algorithms. And so I really like the idea of being very precise and very disciplined when it comes to intraday trading, really, of anything. Okay, so the next kind of thing I want to cover here is how to combine automation with trader skill. Because like I mentioned, I'm not a fan of just plugging in a black box automated system and expecting that to make you money on autopilot. I think it's really important to recognize what software is really there for. And I think we should let it do what it's designed to do, which is making a motionless and objective analysis. But on the flip side of the coin, we need to let us do what we do best as humans, which is analyzing and making adjustments to live market conditions. At least where we are in 2013, I still think a human can think better than an algorithm can, and can look at the live market and interpret and read that live market and spot shifts in market conditions a lot quicker than an algo can. So if you combine both of those, I think you're going to actually have an edge over somebody who's just using one or the other. Another thing that I like to do is to strive to trade better than any system's baseline. In other words, if you look at a back-tested data set, strive to actually outperform that in the live market. And there's some kind of obvious things that you can do, like not trading during losing time periods. One thing that we've noticed in many markets is during lunch, it typically gets really choppy, and we have drawdowns through lunch. So we typically stay away from trading during lunch, right? Another one is maximizing profit targets based on current volatility. And so what I like to do, and I'll just show you an example of this, one really nice tool that you can use for measuring like current volatility is Fibonacci extensions. This is just a really great tool that I've used for a long time. And basically what you'll do is you'll measure a run, measure a retracement, and basically look for the expected second run in that move. And so if you just measure the run minus the retracement, you can see our first profit target was here at the 61.8 extension, and that's where we got out of this trade, right? And so it just, if you're zooming in on the market, even if you're, maybe trading a 15-minute chart or something that you can look at runs and retracements intraday, I really, really like the Fib extension tool. Intraday, basically day trading, James. Yeah. And most importantly, I think it's important to trade in a way, and I know Jeff hit on this, trade in a way that fits your personality and comfort level. You can give a winning system to two traders. Trader A makes a ton of money where trader B blows up. And the reason why that happens, I think, is because trader B might not be comfortable with either the risk size or the drawdown or the time frame. So it's really important just to kind of predefine what you're comfortable with, what your comfort level is, and then just trade within that. Because even if you have a winning strategy, if you try to trade outside of that comfort zone, you're going to basically not stick to the rules, right? Yeah, Jackie, fibs are great, you know, and they're kind of a self-fulfilling prophecy, right? And I like to use Fibonacci a little bit differently than most people do, but I think if you're looking for, um, you know, ways to really maximize your profit targets, fib extensions are a really, really helpful way to do that. Yeah, absolutely, James. How do you know when it's a good point to draw the fib extension? Do you wait for a certain move or a crossover? So it depends on the time frame that you're trading and what type of price action that you're looking at. So you can see here my bars, I'm just using high-low close bars. You could use candlesticks too. I really like candlesticks. But basically you're just looking for a run and a retracement, right? And then whenever you have a run and a retracement, then you can measure that run and find the Fibonacci retracement levels. And then once you have that, you can kind of look into the future by measuring that extension and predicting where a measured move could come from, right? So you could do that on any market in any time frame, but it's just a really nice way to look at what's current, relevant, and important in the market right now. And that's why I really like tick charts, because you can really zoom in and find that intraday psychology behind price action. P.S. How do algos take advantage of traders? Well, so algorithms are quick, right? You have, and under the trading algorithm bucket or umbrella, um, you have a variety of different types of automated algorithms, everything from high frequency bots that are placing thousands and thousands of orders, even to, you know, swing trading algorithms that are slow and just making one or two trades a day maybe. So there's a pretty big range of what algorithms are and what they do, but really they're designed to be quicker and smarter than the slow and emotional trader, right? And that's why I think in today's trading arena, it's so important to really predefine your strategy. And that's kind of a good segue into recapping the three keys for finding confidence, which number one is to implement, test, and validate a rules-based approach. Really make sure that you have an edge and that you're not just kind of chasing lucky cherry pick trades. And then number two is develop expertise in spotting shifts in market conditions and making flexible trading decisions on the fly. And that is a skill set, right? Trading is a performance activity. It's something that, you know, like golf or poker or chess, you really have to first learn something, right? Gain the knowledge. And then number two, develop the skill to be able to execute based on the knowledge that you have, right? And I think it's just a really good skill to have to be able to really develop the expertise in spotting shifts in market conditions. And so next week in the live market class, I'll actually show you how to do that. And then finally, number three is learn to think like a chess player. In other words, learn to think two or three steps ahead of your opponent or the market. Anticipate all of the possibilities, basically everything that could happen in a particular trade, and the probabilities, what's most likely to happen in a trade. For example, when we get into this trade, all the possibilities are, well, the market could run to our target, or it could fail below this level, right? And so we want to kind of know everything that the market could do at a certain area. And based on our testing and just knowledge of how the market works, understand what's most likely to happen or understand the most probable scenario. Yeah, absolutely, BH. So yeah, good point. The difference between a chess player and a checkers player is chess is long term and checkers is short. Yeah, either way, it's really just about kind of pre-planning what you expect to happen a few steps ahead of the game, right? I find so many traders that kind of have this knee-jerk reaction to the market where the market does something and they get nervous and then they take an action. But the idea, if you can really kind of pre-plan everything and think in terms of possibilities and probabilities, it's going to allow you to trade in a more calm and comfortable way because really you're not going to be surprised by anything that the market does. Yep, absolutely. Can we get some insight on the actual strategy? Yeah, so we don't have a whole lot of time to go through the details of what setups I'm taking and management styles. One thing I'll tell you is on the E-mini markets and with the map trading strategy, there's a three-step process that I go through when looking for a trade. And I think that this kind of methodical way to find a setup is relevant in any market. Number one is determining market direction, or what I call momentum, right? So if you can make it an objective way to know if you're looking for longs, shorts, or nothing, it's going to really add clarity to your trading, because if you're looking at the market and you have kind of a battle in your mind between, well, I think the market could go up here, I think the market could go down there. If you have a really objective way to determine market direction, that's going to put you, ahead of the game. And then number two is find a high probability area. Basically an area where you have multiple layers of probability that say an area is going to hold, right? And from there, find criteria for a trade setup. Okay, so for example, the way that we do this is we first determine market direction by looking at the background color of our channel bands here. So you can see on the left-hand side, when this is magenta, it means we're looking for shorts. And then when it shifts to the upside here on the right-hand side of the chart, when it turns cyan, it means we're looking for longs. And then whenever the market is choppy, it'll actually go brown and tell us, okay, there's really no edge to market direction. And once we have a clear read on market direction, then we look for a high probability area. So you can see as price pulls back here to a Fibonacci retracement level, so it comes right to that 23.6 level, we have multiple layers of probability saying that this area, this support level should hold. And if our criteria are met for a trade setup, then we go to step number 3, which is the entry. And we look for a specific type of price action, and we look at the anticipated reward, right, from that area. And then if you have good risk to reward and you have price action at that level, go ahead and pull the trigger. So, again, your strategy might look something similar or completely different. It doesn't matter. The idea is just to have a methodical way that you, number one, determine market direction. Number two, you find a valid trade area, something that has criteria for a trade setup. And then number three, very clear rules for when to pull the trigger on an entry. Because if you recall, in the beginning of my presentation today, I was talking about the two things that trip traders up the most, which the first one is hesitating on entries. So if you have really clear rules for when you actually pull the trigger on an entry, that's going to kind of clarify that, and you'll have less anxiety when you're trading the live market. Yeah, I'm talking about the S&P. Yeah, these are tick charts. So this is a 610 tick chart, which if you're not familiar with tick charts, it basically measures transactions. So for every trade that fires off in that market, that's one tick. So for every 610 transactions, we'll get a new bar that plots. So it's not tied to time, right? Like one bar can take 10 seconds or 10 minutes to play out. so you can get a really good feel for market pace, basically the speed in which the market's trading. Doug, do you agree that entries are the most important factor in being successful day trading? I think it's one component. I think trade management is probably the most misunderstood, and I think trade management is very, very important too. So you have all these different components of a trading strategy, right, Doug? You have the entry, you have market direction, you have the setup, and then you have management. And I think they're all equally important. If you're missing one of those pillars, then it all comes crashing down. James, does it work with TradeStation? So I use TradeStation for equities trading and swing trading. I use NinjaTrader for my intraday trading because it's very, very responsive. It handles tick charts really well, and the testing functionality is great. And it's the learning curve is really short as well. Yeah, absolutely, Doug. Yeah, great comment. Yeah, Jerry, so the coloring is momentum. So over here on the left-hand side, when the market's down, when momentum is down, we're only looking for shorts. You can see we had off of market open, we had a short that failed, got high ticked, and then the market continued to go down. And then here around 9:15 Central, we had a shift in momentum. So right here, we went from looking for shorts to looking for longs, and then you'll notice the market trended up for a while. Yeah, George, so if you come to the live class next week or the week after that, yeah, because we have the 4th of July, I'll go into detail of each indicator and how they all correlate and all that good stuff. And so actually, why don't I go ahead and pop that up? Just go to eminiacademy.com/live, and if you just put in your name and email, that'll register you for that class, and then we'll have plenty of time in the live market and to do unlimited Q&A and all that good stuff. You should know your entry and exit before you place the trade, and then continue to manage it. Yeah, I agree. I think BH, I think it's really important to predefine your risk before you pull the trigger, your risk and reward, right? Predefine where you anticipate your targets to be, predefine where the market should not go, which is where you should have your stop behind, right? So yeah, I completely agree with you. Yeah, Robert, so the question is, are you using custom algorithms for your chart? Yes, so we have basically rules for 3 different trade setups, and they're very, very clearly defined rules. And our coders actually laugh because I think we have well over 10,000 lines of code now. It's a little obnoxious, but we've been developing and constantly working on the map trading strategy for like 6 years now. So it's evolved into something that's very sophisticated, but at the same time, we want to stay flexible with market conditions and have a strategy that's robust that doesn't just blow up as soon as market conditions change. I think that's really important. When is the live webinar? It's on July 11th, Thursday, July 11th at 2 Eastern. Joel, do you use any other tick charts? If so, what number? Yeah, so for different markets, we have different tick charts. To give you an example here on the TF or the Russell 2000, I use a 233 tick. Kenny, the class is free. Yeah, absolutely, HP. So basically, getting back to the question about timeframes, we use different tick charts for different markets just based on the way that they move and the liquidity. So we use anywhere from an 89 up to a 1597, depending on the market. Yeah, Jane, if you just register, if technology cooperates, which it usually does, I'll send you the recording. Sure thing. You use two speeds on the EOS? No, we just use the 610. We used to use multiple time frames for each market, but what I've done is we've actually coded our strategy to analyze multiple time frames behind the scenes. So we just need to focus on one chart. All right, guys. Well, I hope this was helpful. I'm going to go ahead and wrap it up, but just to kind of recap what we've covered, no matter what market or time frame or strategy you're trading, I just think it's really important to go through this process to try to eliminate, subjectivity and discretion, and really develop confidence, number one, in your strategy, and number two, in your ability to execute that strategy. And I think the most important thing is really just to think like a chess player. Learn how to anticipate a few steps ahead of the game and anticipate probabilities and possibilities. And that right there will just give you a whole another level of clarity and confidence in your trading. So, yeah, Jim, we have a few different membership options. And if you go on our site, you can find that. Again, I don't want to sell you guys anything today. I just really wanted to add a lot of value and hopefully give you guys some good training. And so feel free to explore our site. And again, we're going to be doing this live market class on July 11th at 2 p.m. So just go to eminiacademy.com/live and you'll be able to get into that. So thanks, HP. Thanks, Carmen. Thanks, guys. All right. Well, Morgan, I'll go ahead and pass it back to you. Guys, thank you so much for having me here. Again, I know you could be anywhere on a Sunday or a Saturday in the summer, and you were here listening to me, and I really appreciate that. So thank you guys so much. I look forward to talking to you soon. And Morgan, it's all yours.